We'll go ahead and kick things off. Good morning, good afternoon, everyone. Welcome. We're so glad that you could join us today for our first quarterly briefing of the year. My name is Danny Berkey, Director of Marketing at Park Avenue Capital, and I'll be your host for today's webinar. At Park Avenue Capital, we know one of the most important aspects of an advisor's role is helping clients stay grounded in a world that can sometimes feel very noisy when it comes to investing and financial planning. So our goal with today's session is to take a step back from that noise and focus on what truly matters. And we'll be doing that in a fun Shakespearean fashion today with the topic of Much Ado About Nothing, lessons from 8 years of speculative theater. So we're hoping that it will be a fun yet informative session. And as a reminder, it will be an interactive session. We encourage you to submit your questions throughout in the Q&A feature, and we'll be monitoring those and have dedicated time at the end to address those. We will also launch a quick poll at the end of this webinar to gather your feedback. So if you could hang on till the end, we would greatly appreciate that. And with that, I will go ahead and introduce today's speakers. So I'm excited to introduce first and foremost Chris Bremer. He is our Chief Investment Officer and resident webinar presenter of this series. He heads our investment research, portfolio strategy, and asset allocation at Park Avenue Capital. He brings nearly 2 decades of experience, including senior leadership at Northwestern Mutual and helping guide disciplined, institutional level investment management at our firm. And with that, I'm also excited to introduce our second speaker for today, Fred Ulbrich. Fred joined our firm roughly 4 years ago, bringing with him a wealth of experience and expertise in the financial planning industry. He serves as our Director of Portfolio Management and oversees and is responsible for clients' portfolio construction, security selection and monitoring, and active participation in our investment committee. Before joining our firm, he had 5 years of experience at New York Life as an investment consultant. And in that role, he was instrumental in providing customized wealth management solutions to advisors and high net worth clients. His strategic insights and dedication to client success distinguishes him in our field. So thank you, Chris and Fred, for joining and hosting this webinar for our clients today. And with that, I will go ahead and kick it over to Chris.
Thank you, Danny. Good afternoon, good morning, wherever you are. Thanks for joining us, Fred and I look forward to these webinars because it gives us an opportunity to do what we love doing, which is talking about not just how we think, but what we think as well. Our objective today is the same as always, to give you insights into our investment philosophy, how we think about the markets over the long term and what that means for your financial plan. We do draw on feedback we receive from clients, so thank you for those that have offered it. Speaking of feedback, before we begin, our client feedback on these webinars has been roughly 50-50. So half of you want us to go deep into market concepts. The other half prefer high-level overviews. On any given topic or slide, the scales may tip one way or the other, but we're trying to achieve balance in the aggregate. So if I tip too far in one direction, well, today we can blame it on Shakespeare. So before we get into the main content, let's address something that might be on a lot of your minds: market volatility. There's a lot happening in the news today. The sheer volume of headlines can be overwhelming. There's a distinction, I think, that matters. That is between perceived volatility and realized volatility. They are not the same thing. It's easy for all of us, myself included, to construct a mental framework where the markets feel highly volatile. And that matters because the feeling can distract us from the way we think about our financial plan. As of right now, the S&P 500's actual volatility is below average, sitting at the 36th percentile over history. It feels volatile because the media has a business interest in making it feel that way. Now, average volatility over a lifetime of markets is not a straight line, as you can see on the graph. It's composed of periodic spikes that pull the average upward, sharpening otherwise calmer stretches. Here's a fact that might be surprising to many. The S&P 500 spends approximately 65% of all trading days below its historical volatility. So the mean is dragged up by these more extreme but infrequent spikes higher. That's just the nature of the long-term markets. But these spikes are factored in to every financial planning scenario that we run for clients. That said, we fully acknowledge that today, in today's environment, there are very legitimate reasons why volatility could spike at any time. And we should expect that. But there's always reasons. The problem is those occurrences are unpredictable. So we focus on what we can control. And I think that's the critical distinction. The last one to make is between volatility and risk. Volatility is a price of admission for getting those long-term market returns. The real risk is overreacting and selling at the wrong time. So that's the risk that we spend our time trying to manage for our clients and among ourselves. Shakespeare wrote Much Ado About Nothing in 1599. It's a play about people creating enormous drama, making terrible decisions, destroying relationships, all over things that turned out to be really nothing. Deception, rumor, manufactured anxiety. If you have had or lived through teenage girls like I do currently, I think you know exactly what I'm talking about. In the play, the villain does strange things, manufactures scenes that are so convincing to the other characters that they abandon their judgment, they act on emotion, and nearly destroy everything they care about. These crises are manufactured, but the damage can be real. If that sounds familiar, it's kind of like the last 8 years of the markets. Why 8 years? Well, it's a formal inception of our current investment committee. And when we reviewed 8 years of our own writings, from internal memos, client letters, weekly commentaries, the volume could fill about 5 or 6 novels, but we found 60 to 70% of everything we wrote about was in some form directly related to or a response to speculation. So manufactured drama, things that for a disciplined investor with a plan ultimately amount to not a lot of anything. So the drama of the last 8 years really has the same bookends. We started with tariffs and trade, and in 2025, we ended with tariffs and trade. In between, we had all kinds of things: a pandemic, inflation, bank failures, elections, crypto manias, you name it. Over this period, this 8 years, we experienced drawdowns. So from market highs of 34%, 24%, 20%, 19%, a couple 10%ers, and multiple 5%ers. And yet, the global equities over this entire period are up over 130%. And the S&P 500 is up over 170%. So let's start with Act 1, 2018. So we're going to just go year by year, give a recap, and then we're going to get into what some of this means for us. So our act begins in 2018. Some of you might remember this. We had a fourth quarter market correction of almost 20%. And every day brought seemingly a new tweet. Many of you will remember President Trump then tweeted in December that he was a tariff man. Oh my gosh, what this did to the news media. So you can see the spike in news media here in December. And what's strange is not the tweet itself, but what it caused among the financial industry. So to this day, I'm still confounded that major reputable investment firms began analyzing the president's tweets day by day for making investment decisions. And I've never seen anything like it. And it was one of the more preposterous things I've seen from firms that should have known better. So we wrote about it at the time. We noted how the so-called experts were completely flabbergasted by this correction, and that it would pass at some time. And it did end on Christmas Eve, and the market went on to recover in 2019. In 2019, we call the year of the fear merchants. So this year did not bring any overarching crises. Instead, we got a constant, unrelenting, low-grade grind of anxiety headlines. So the yield curve inverted briefly, which was a precursor to what would happen a couple years later. The financial media discovered its favorite word, the R word, recession. And then the repo market had a hiccup that was treated like the second coming of 2008. We wrote at the time that this is really just clickbait intended to cause emotional reaction, leading to clicking on news stories. But here's the thing. On the right side of our slide, it's the most important and a little bit painful part of it. We had a client in March 2019 who, for whatever reason, directed us to sell 2/3 of an all equity portfolio. into short-term treasuries. We counseled against it. Nothing in their plan seemingly had changed, but they insisted. To successfully time the market, you have to get all of those 5 things right. And we went into this in more detail in previous calls. We won't do that now. But getting these things right is extraordinarily difficult. And if you're making a series of tactical calls, getting each one right is virtually impossible. Well, the S&P returned 31% that year, and the client returned negative 12%. These are the big mistakes. So when you hear us talking about the big mistake, these are the big mistakes. 2020, obviously we had COVID. Now, to be clear, COVID was not about nothing. This was a very real, and our connection to the Shakespearean theme is strictly related to the financial planning part. We know that the S&P 500 experienced the fastest bear market in history, down 34% in 33 days. It was a relentless, gut-wrenching sell-off for all of us. Had we reacted impulsively, and investors had every reason to, that could have been ruinous for long-term outcomes. And we wrote during the worst of the sell-off in March 2020, ultimately, this crisis will be resolved. The market will either resume its recovery or initiate a recovery off of a new low at some point in the future. Whatever the case, this uptrend will occur before most people feel confident about the crisis resolution. In fact, that last line I think is key. Markets tend to recover before news gets better. It's easy to understand this concept when things are calm. We tend to lose sight of it when the world feels like it's falling apart. And in good markets, the reverse is also true. So the market did fully recover in 5 months and finished the year up 18%. And our clients, nearly all of them resisted the emotional temptation. In fact, this is one of our proudest moments. We love this chart. It's one of our favorites. This is just a part of what is now Park Avenue Capital business. But most clients back then leaned into their financial plan. So clients rebalanced from bonds and bought stocks when they were down, and clients that had extra cash to put to work in their long-term plan, that's exactly what they did. So the yellow bars are net flows of dollars into retirement portfolios. And we were incredibly proud of our clients at the time for doing that, and obviously been significantly rewarded for taking the right course of action. In 2021, this could be my favorite year. This is what we call the speculative mania. I think many of you will remember this. This is different from every other year on the list because the crisis really didn't originate from the outside. It really came from the inside. Yes, it was a reaction to the COVID year, but these were highly speculative investments promoted by social media influencers and the like, and then more precisely than it was the preamble to the 2022 bear market. So I'm sure many of you remember all this. We had meme stocks, we had GameStop, AMC, we had crypto, we have NFTs, non-fungible tokens, selling for millions of dollars. SPACs, special purpose acquisition companies, accounting for nearly 64% of all IPOs. Someone paid close to $12 million for a pixelated cartoon ape, something that you could just like snapshot. Anyone could do, and many people did. And with impeccable timing, an NFT ETF launched in December 2021. So most investors lost everything in that. But it gets worse, unfortunately. And this is part of the irksome side of when things become a little bit, corrupted. So this slide shows how speculation creeps into the mainstream. And how incentives can alter the perceptions and the way that normally responsible institutions are supposed to act. A financial planning study on investment trends, the very first words, the very first sentence in the study was effectively promoting crypto investments. And if you look at the bottom right, one of the sponsors of the study was actually a crypto firm at the time. So we talk all the time about incentives, and yet we probably don't talk about them enough. So, Park Avenue Capital obviously maintained our investment standards throughout this time. Zero crypto, zero speculative assets like this. And for many, it might look prescient at the time. But at the time, we could have been accused of being boring, which I'll take all day. And 2022, of course, was the great unwind. So we had the inflation shock, and I think it's vastly underappreciated. We refer to the 2022 bear market as the all things speculative and private bear market. The chart you can see shows the white line, everything's based to 100. The white line is the S&P 500. It fell over 20%. You can see the blue line is the NFT index that I mentioned. And then all of the private and speculative assets just really took it on the chin. And I think at the time we wrote that the most speculative parts of the market have been leading the correction. Isn't this normal? Corrections help remove market excess and weak players, those without a plan who are prone to panic. So on the inflation specifically, when everyone was being sold gold, commodities, tips, every inflation product on the shelf, we noted internally to our advisors as communication to, I think we know it to clients too, the best inflation hedge over the long term is long-term allocation of stocks, period. It's the most reliable hedge. Everything else, stocks might go down when inflation comes up temporarily, but over time, it's the most reliable. So the answer is the simplest one: own productive businesses that can raise prices over time. That's not a product, not a gimmick. So try to avoid the gimmicks. And unfortunately, in 2022, the industry also lost a very, very dear friend. We had to say goodbye to the 60/40 portfolio. The 60/40 portfolio passed away. The death was widely reported in obituaries everywhere. What's a 60/40 portfolio? Well, it's a proxy in the industry for a basic stock and bond portfolio. Think of like legacy trusts. That's what a 60/40 portfolio is: 60% stocks, 40% bonds. Incidentally, this portfolio has died about a dozen times in the last few decades. And we have been watching the story develop for a year. The reason why it was being promoted this way is literally, you would see article, the death of the 60/40 portfolio, was because bonds had a bad year also in 2022. That was an anomaly. But the thing is, we had been talking about this for years, and we had been writing about this in our annual letters to clients. And it was that the irrational exuberance was not where people thought it was. We wrote, recent record liquidations of equities shows the broader public sees no reason to own stocks no matter what the market does. Let me just stop there. So for the last 10 years prior to that, the public had been investing a lot, trillions more in bond funds than stock funds and ETFs. We continued. As the price of the 10-year treasury sits at record highs, the irrational exuberance is actually in bonds. It wasn't that we were predicting a bond market decline. It was the main point is that arbitrarily high allocations to bonds carried more risk than most investors thought. That's why we undertake the financial planning process to allocate thoughtfully according to each client's plan between stocks and bonds. And since the aftermath of 2008 crisis, there was a permanent fear of equities in the public. By 2021, the only way to get more return from bonds was either, because yields were so low, it's either to increase credit risk or leverage. And there's far more risk in bonds than was commonly understood. So when bonds finally corrected in 2022, which means interest rates move higher, that means bond prices move lower. Bonds fell about 13%. That was an extremely bad year for the bond industry. But the 60/40 was never dead. The bond market was correcting from a period of excessively low interest rates and irrational exuberance that came with bond flows into bond funds. So the problem was bonds have been mispriced for years, but we, as an industry, we really didn't want to admit it. But the framework still held. 60/40 portfolio never died. Bonds still offer diversification benefits historically. Just because it didn't one time doesn't mean something is dead. 2023, we had the bank failures. So three banks failed in a single year in 2023. Silvergate, Silicon Valley Bank, Signature Bank. The media narrative was immediate. This is 2008 all over again, except it wasn't. What the problem was with the business models, not with the economy or the broad markets. So the business models of these banks failed. They did some things that they shouldn't have done, and many of them had either crypto related or direct crypto exposure of some form. So this contagion never really spread. We didn't think it would. In 2023 was also the most bearish forecast year on record for Wall Street strategists. And media mentions of the word recession in stories actually exceeded the number of recession stories during the COVID year. 2024 is a noise machine. We had 6 distinct alarm bells every time this dominated the headlines for weeks. Inflation was reaccelerating, except it really wasn't. It was car insurance and CPI rents. Beyond that, it wasn't that broad-based. We noted that the concentration around the Mag 7 and the technology, really came to prominence in 2024, and that argument has stayed with us since then. We had Fed anxiety over potential rate cuts, or anxiety over potential Fed rate cuts. We had a yen carry trade. Goldman Sachs forecast 3% annual returns for U.S. stocks over the next decade. That caused a lot of buzz. And basically all the professional forecasts failed, and the S&P turned in another good year. 2025, we mentioned this in our last call, our theory of ripping up the textbooks. And this is the bookend again. So we're back to tariffs last year, back to trade headlines. But something else was happening that we tried to articulate in this theme, ripping up the textbooks. I was taught in college that free trade and comparative advantage is good. It's mutually beneficial for all. That's out the window. Economics 101 teaches us that tariffs are a tax, and taxes represent friction to free commerce. Global diversification theory says if you invest globally and benchmark to global indexes, that's a good thing, but the emerging markets index at its peak had China close to 40% of that benchmark. International relations theory says that alliances with countries sharing similar values preserve peace through strength, and we're now weakening those alliances. So a lot of the things that we are used to from an economic, investment theory, geopolitical perspective are being unwound. That's just the reality we live in. Unfortunately, calm and peace was the historical anomaly. And we wrote about this in 2018, and we've been writing about it ever since. So the world has changed. I wish I had better news on that front. We don't, but we cannot plan for this. So we should anticipate more geopolitical friction as we continue. But the plan is there because the plan doesn't account for the specific types of friction. It accounts for the volatility inherent in these adjustments. And so from that perspective, we just want to be mindful that we can't predict what's going to happen, but the plan is designed to keep us in adherence to our plan without having to think we have to make adjustments based on what's going on in the world. With that, I'm going to turn it over to Fred to talk about speculation versus investing.
Awesome. Thanks, Chris. As Chris highlighted, there have been tons of market narratives over the past 8 years designed to capture investor attention. To complement these headlines, product sponsors have captured fund flows from investors who make decisions based on this noise, not within the context of a financial plan. Some of the loudest, urgent, and most sophisticated sounding investment stories were a distraction from long-term planning principles. Over the next 10 minutes, I'm going to walk you through 4 specific products, each having generated their fair share of attention over the previous 8 years, with each product pitch sounding as actionable as the next. Many of our clients have asked about one or more of the investments we're about to cover: Bitcoin, NFTs, structured notes, or thematic ETFs. These were completely reasonable questions as the products were constantly in the headlines. Some of the most sophisticated investors in the world were paying attention to them, so of course our clients asked. What we are reviewing today isn't a verdict on those questions. It's a window into how our investment team thinks. Specifically, how we evaluated each of these opportunities when they were at their loudest, and why in each case we came back to the same conclusion. The framework isn't designed to make anything sound foolish in hindsight. It's designed to give us consistent, repeatable way to evaluate any investment. The ones generating headlines today, and the ones that will generate headlines 5 years from now. So before we get into the specifics, I want to give you a simple three-part test that we apply to each product. Does it represent a durable claim on productive cash flows? 2, does it improve implementation inside of a long-term financial plan? That's the time horizon test. And then 3, are the incentives aligned with you, the client, or with the product sponsor and media ecosystem around it? And with that, let's start with Chris's favorite topic, crypto. So Bitcoin is probably the best known example of crypto from this period, and I would argue the most instructive. It combined technological novelty, anti-establishment branding, scarcity language, celebrity endorsements, Super Bowl commercials, and relentless media coverage. It wasn't just sold as an investment, it was sold as a referendum on whether you understood the future. There have been many other narratives to justify Bitcoin's existence, such as the DeFi movement and Bitcoin as digital gold. While the storylines around Bitcoin constantly shift, our view at Park Avenue Capital has not yet changed. Bitcoin is not a suitable investment in a long-term planning portfolio. It does not represent a claim on earnings, cash flows, or dividends. When we underwrite things like public equities, we're underwriting productive enterprise, future earnings, dividends, capital expenditure. With Bitcoin, the entire return thesis rests on what someone else might pay later. That is not a strong foundation for a financial plan. And here's the behavioral problem. It introduces an asset with extreme volatility and then asks you to stay steady while the media ecosystem monetizes every swing. That runs directly counter to what we're trying to accomplish together. This chart on the next slide is one of the most powerful exhibits on incentives that we've recently seen. So at Bitcoin's peak, IBIT, which is the iShares Bitcoin ETF, this product generated more fee revenue than the iShares S&P 500 ETF, which is one of the largest exchange-traded funds today, despite having only 1/7 of the assets. So this isn't a commentary on BlackRock. It's a lesson on incentives. When institutions can charge dramatically higher fees on non-core products, they have a strong financial motivation to promote them, regardless of whether those products belong in your portfolio or the issuing company believes in the merits of the underlying investment. That's free enterprise. We just want you to see it clearly. On to NFTs. Before we dive into this topic, does anyone know the name of this piece or remember the artist who published this? I'll give 5 to 10 seconds here, see if there's any activity in the chat. Any takers? Any takers at all? All right. So what we're looking at here, this is an NFT from the artist Beeple. It was called Every Days, the First 5,000 Days. This was sold by Christie's in 2021 for an eye-watering $69.3 million. If Bitcoin was speculation with a serious face but unserious thesis, NFTs were speculation without the disguise. No cash flows, no earnings, no yield, no place in any capital market assumptions we've ever seen built, just a digital file, essentially a JPEG with a story and the hope that someone else would pay more today. While it's challenging to value this specific piece from people today, there are estimates that roughly 95% of all NFTs are now worthless, resulting in massive capital destruction for those who chased a hot trend. NFTs were a grift in their purest form. Moving on to structured notes and buffered ETFs, or what we now are hearing called as defined outcome ETFs. This category is especially important because it's where speculation disguises itself as prudence. Structured notes and buffered ETFs aren't sold as exciting, high-flying products. They're sold as thoughtful, engineered ways to stay invested while reducing the downside. That emotional appeal is exactly what makes them effective marketing tools, particularly in volatile markets. We have clearly seen demand for these products rise as the 12-month growth of the defined outcome ETF space has been over 40%. This growth has led to large transactions in this space, such as Goldman's recent acquisition of Innovator Capital Management. For those who haven't heard of Innovator Capital Management, I would say that they're considered one of the pioneers of these defined outcome ETFs. But here's our core concern with these products. Your financial plan already solves the volatility problem. The planning process determines your stock to bond mix. It accounts for your spending needs, time horizon, and risk tolerance. It factors in various market conditions, both good and bad. Layering on engineered downside protection often double counts a preference for safety while sacrificing the long-term upside of core equity exposure. In addition, in our view, there are many other problems with structured note products, to name a few. They're typically tied to performance of an index without dividends. And let me repeat that, it's without dividends. Many notes are auto-callable, essentially meaning the sponsor is incentivized to call or redeem the product early if the index is performing well. And you are typically going to hold the note to maturity when the index is underperforming. Talk about incentive mismatch. These typically have a limited downside buffer. So if the performance of the index exceeds the buffer level, you participate fully in the downside. And as previously mentioned, they cap your upside. When the market experiences significantly higher returns than the cap, you do not participate in that upside, which is a massive setback to long-term compounding. No claim on durable cash flows, not suitable for long-term holding periods, and mismatched incentives. Defined outcome ETFs and structured products more broadly do not meet our investment implementation criteria. Now on to thematic ETFs. Thematic ETFs show that speculation doesn't always arrive looking reckless. Sometimes it looks modern. A theme gets hot, AI, clean energy, cannabis, the metaverse, and product sponsors race to package that story into a ticker. And once the flows start, the story can feed on itself for a while. The problem is thematic ETF flows tend to arrive after attention has already been built and strong performance already realized. They monetize investor excitement in the present without the consideration of longer-term returns. And if we look at this graph on this slide, we looked at one specific thematic ETF, the Global Clean Energy Fund. The yellow line is the relative price, so how global clean energy's price moved relative to the S&P 500. So if yellow line is increasing, it represents global clean energy outperforming. And if it's decreasing, it represents underperformance relative to the S&P 500. And the blue line represents flows. You will see that flows peaked exactly at the top of the relative outperformance of this fund. And while this is one specific example, Chris and I both can show a handful and I would say a boatload more of these types of products. And really, here's the thing with thematic ETFs. Most of the exciting innovations in the economy are already accessible through broad public market ownership. You don't need a special wrapper every time the world gets excited about a trend or a special product. The question is never whether that theme is real. Many themes are real. The question is whether buying a narrow product after it's already popular improves your probability of long-term planning success. And in our experience, it rarely does. The following data reinforces the incentive problem with some of these more narrow-based ETFs. Average ETF fees have been drifting higher in recent years, as illustrated by the graph on the left. This has really been driven by the proliferation of thematic income and levered ETF products. And the graph on the right shows that the share of ETF flows going to low-cost products has dropped to a multi-year low. While you can argue that some of these thematic ETFs may have durable cash flows, in our experience, these themes are short-lived and not suitable for longer-term planning periods. The higher margin product favors the product sponsor more so than the client. We use ETFs as efficient vehicles for core exposures, not as wrappers for tactical bets or outsourced risk management. The goal isn't to find the most interesting ETF. It's to maximize the probability of meeting your objectives through a repeatable, evidence-based process while controlling costs, taxes, and risk exposures. If you personally find any of these investments interesting and want to allocate discretionary capital to one of them, money outside of your financial plan, money that you're comfortable losing, that is entirely up to you. What the investment team will not do is put speculative assets inside of your portfolio designed to fund your retirement, your family's future financial security, and your children's education. These dollars have a job, a specific modeled probability-driven job. Speculation doesn't have a job description. And with that, my scene comes to an end. I'll hand it back over to Chris to bring this show home.
Thanks, Fred. So if anyone listens to Bloomberg Radio, Tom Keene is a host, and he has a phrase he always uses called ripping up the script. I'm going to rip up the script right now. So before I get into it, I just want to connect what Fred said the last 10 minutes. We have talked in the past about the fact that we're not making changes to the portfolio doesn't mean that we're not thinking about things. And I think the last 10 minutes I think you would concur with me, was the best representation of that process in play. So I don't think that could have been described any better, that to know that if we're not doing anything in the portfolio, it's not because we're not looking at things. So I think you'll agree. Terrific explanation the last 10 minutes. It really puts things into context. Thanks, Fred. So I want to get into on the scale of like going deep into a concept or versus high level overview. So please bear with me for the next couple minutes. We're going to go into a deeper area, but I think the framework can be useful for those who haven't heard of it before. And for those who have, I think it can help reinforce the way that we view the world. So Fred just walked you through why these speculative episodes explain why we don't engage in some of these, but why did they happen in the first place? And so there's a concept from economists. Now, many of you will know the economist name, John Kenneth Galbraith, and many of you have heard Peter DeBoris offer a very, very famous quote. Well, this is the same economist, and he's got another theory called the bezel. And I think it's important for describing some of these the way that the investment world thinks about things. So if you think about the bezel is an explanation for how markets get away from themselves. And think of it as embezzlement of rational value by exuberance. So while in good times, there is always some nefarious activity going on, yes, but you don't necessarily need somebody to intentionally defraud during a period of the bezel. So basically, there's a gap between what people think they're worth or what their investments are worth and what they're actually worth. Now, multiply that times a million for the markets. So when everyone thinks they're wealthier on paper, nobody notices this gap. And while the music is playing, market participants unwillingly promote this bezel. So if we take this a step further, or actually simplify a little bit, Robert Shiller, Nobel laureate, explains what happens next. Rising prices create belief. Belief brings in new buyers. New buyers push prices higher. He calls this the naturally occurring Ponzi process. Not because anyone is running a scheme, but because the process is self-reinforcing. By the way, there are many schemes being run today, too, to be clear. But it's supported by people who mistakenly believe in it. This is some of the most effective marketing that there is. And then Schiller, along with economist Akerlof, explains the final piece, the true believers. The mechanism that doesn't need conscious fraud to spread, since believers, and these believers are now your colleagues, they're our colleagues, your brother-in-law, your sister-in-law, another financial advisor you see, or the people you see on CNBC. They come to truly believe in the effective transmission process of investments like the kind that Fred just described. The incentives, the narratives, and social validation all serve to reinforce the bezel. This is why we have implementation principles and standards. It's not that there are not good investments. It's that principles endure, strategy and tactics can change, but principles endure. And the whole the whole importance of the financial planning process is to protect yourselves from these situations and to protect us from getting into situations in your portfolio that you shouldn't be in. So I think it's just a good way to frame how some of this stuff comes up. And I think now the logical question is, okay, so what might be next? And this is not a prediction, but it is useful, informative to think about the world that we live in and think about the potential risks that could be there. So this is, don't put too much stock into this. This is just more of an exercise and a framework. But we've listed out a couple candidates in the current environment where, there could be differentiation between the bezel and real risk, for example. So, you've all heard, I'm sure, private credit has been in the news. We put this, for example, in the bezel category. It's not that we don't believe in private credit. Private credit serves a very useful function. The problem is the translation mechanism from its original design into retail client portfolios. Things get lost in that process. And a lot of what's going on in the private credit industry today is probably a result of this concept of the bezel. Nobody is trying to defraud. Nobody's trying to do anything wrong, but there's just too much money chasing the same thing. Same with Bitcoin and crypto. I think we made our position clear there. It's okay to have a personal opinion on the merits of any individual investment. That's not. We have no qualms about that for anybody. It's just the problem is, does it fit the standard of our portfolio implementation? I think we have talked in the last couple of sessions on AI technology, AI infrastructure. This one could be a little bit of everything. Yes, there could be too much money that ends up chasing some of these things. And too many people believe once there's too much money chasing, returns compress. That's just the reality of cycles. That could be a potential bezel situation. Another thing that comes up from time to time, U.S. debt deficit crisis. That usually, for as long as I've been looking at this stuff for 30 years, that's much ado about nothing. It doesn't mean something can't happen in the future, but all we have is historical precedent to go by. Active ETF proliferation. I think Fred articulated that clearly. Here's the big one. I think many of us share the same concern: China-Taiwan escalation. What is that? We don't know. That's a legitimate risk for the global economy, for sure, and beyond that. I think tariffs and trade wars we've talked about, generally, probably much ado about nothing. That doesn't mean it doesn't have an impact. It just means that we expect the economies and individual companies, they are highly adaptive. So they adapt to the new regime. Maybe growth is a little bit lower, but overall, there's in free and fair markets, there's an adaptive situation going on. Geopolitical conflict, what's going on today. Not to diminish what's going on today, but generally, and we did send out a client note last week, for the most part, markets tend to spike on geopolitical risk, and then they kind of absorb and they kind of look past it. So think about it this way. It's not that the markets are amoral. They're not immoral, they're amoral. And they're looking ahead, looking at the economy, profits, companies, and looking past things. So generally, markets look past it. During heightened times of conflict, yes, you can get higher volatility, which, as we saw, we have not seen yet in the markets, but it could happen. So I think these are some significant things just to look about. We talked about the plan, talked about the year. So in conclusion, the plan over these 8 years, and you can go back farther than that for sure, over these 8 years, the plan was never wrong. There's a lot of noise. Sometimes the predictions, forecasts were wrong, but the plan was never wrong. One of the things we've learned is the most dangerous moment is not necessarily the crash. It's just as likely to be bull markets, good times, because the media is so focused on always presenting the fears and risks that are out there. Those never go away. Those risks are always there. And often good times present more anxiety than even the market sell-offs. Speculation is not investing, as Fred articulated. It's a transfer mechanism, basically from you, the investors, to product sponsors or others. And then, frameworks age and they must adapt. But a plan is designed to endure through all of that. So I think that wraps it up for now. And I think we can get into the Q&A.
Yes, thanks, Chris. Thanks, Fred. Now we'll transition into Q&A. So if you guys have questions, please start dropping that in the chat or the Q&A feature, and we will start addressing those. I see we did have one come in throughout the presentation, so I'll go ahead and address that one quickly. Either of you can answer this one. Question came in, is it possible that the S&P is overvalued and that stocks are priced too high given their PE ratio? Any thoughts?
Is it possible? Yes, absolutely it's possible. The thing about valuations, you just never know. So the question is framed, I think, the right way, which is, yes, it's possible. Then from there, is it probable? I don't know. We talked about valuation in our last quarterly webinar as it pertains to technology and the underlying dynamics of the US economy. The underlying dynamics have changed significantly over recent decades. The economy, the way that you look at historical market valuations, when you look back as far back in history as you can, say going back to usually about the end of 1920s is where most folks have like data. Those historical periods were based on a market index with property, plant, and equipment. Now the market index is comprised of intellectual property. It's very different. Historically, intellectual property type companies, i.e. technology companies, have carried higher valuations in the property, plant, and equipment, which depreciates over time. So there's no right or wrong answer. It is possible, yes. At the same time, earnings have been coming in quite well. And it's possible all the challenges in the world this is possible as well, that all of the challenges going on in the world, tariffs, trade, conflict, are actually serving to prevent overheated economies or things from getting out of hand, like speculation in tech, things like that. So both are possible. We never know, but we do know, and we've studied this, is that valuations do not provide meaningful predictive power about forward-looking returns. And so that's the best thing we have to guide is your financial plan in your own situations, and then how that translates to your asset allocation.
We had one other question that came in, and it's around how our assumptions have changed over the last 8 years. So has Park Avenue Capital had any of their assumptions change around market corrections? So the examples that they gave, the financial market every 13 years, the housing market every 2 decades. Has our assumptions around that changed at all over the last 8 years?
Yeah, interesting question. I'm going to hedge and say yes and no. So here's why. I think the implicit underlying question, the financial, I think that's really pertinent every 13 years. So this leads to a lot of things. So think 2008 was a credit cycle. We haven't really had something like that. So what we're looking for, not to try to predict, but just to understand where we are. And I think this is very relevant to the private credit news that's out there today. Is there a credit crunch in the economy? So far, we haven't seen it. So far, it appears to be isolated to specific niches within private credit. And even though the private credit industry has expanded significantly over recent years, it's still, as a percentage of the total bond market in the economy, is still relatively small. So I think that's what we're looking for. Is there a credit crunch? I think what the the person asking the question as I understand it, is getting at the right thing. The corrections happen all the time. Bear markets that are not associated with a recession tend to last a lot shorter and recover a lot faster. We know this historically, and so we've had a number of these going back to 2018. We've had at least three, maybe four bear markets. If you want to count 19, I include 19% drawdown as a bear market. A technical definition might be 20%. We had one last year, very fast. So things have been moving faster. The economy has generally been pretty supportive. I think a lot of that has to do with the deleveraging mechanism among individual households going back to 2008. I think that was a big part of it. So I think in terms of what to monitor, you want to look for leverage in the system and credit. Leverage is leverage. Those two combinations are the worst. Does it impact the way we look market corrections? No, I think we expect them, and we should. So we put in our client note last week that the average intra-year decline in the market going back to 1980 is 14%. That means at any given time during the year, you would expect from a high point to a low point, a 14% decline. Now, it doesn't happen every year. The average means you might get two in one year, which is more likely the case. So we expect that. That is part of the planning process. That's part embedded in the scenarios that we model every year. And I think most people are still surprised at the sheer number and magnitude of corrections we have had since 2018. And yet here we are. And we did want to go back and review them because we all, myself included, we have recency bias. And so when things happen, when you're in it, it feels really bad. But when you look back and say, okay, we've been through these types of things before. So I don't think that's a very articulate answer, but I think, yes, we are looking at credit, and I think leverage in the system is another big one.
That's great. And we are coming up on time, so I'll go ahead and wrap it up. Chris, Fred, thank you so much. This was a really great presentation. Before everybody jumps off, again, we'd love to gather your feedback really quickly, just on this webinar's content, as well as any other future content you would like us to present on. So this poll should be live on your screen now. If you could just take a few moments to share your feedback with us, we'd greatly appreciate it. And as everyone puts that in, I will go ahead and just wrap it up for today. Chris, Fred, thanks again. Also, as you guys take off, if there's anything from today's conversation sparked your interest, you want to continue the conversation, feel free to email me or reach out to your advisor directly, and we can continue to discuss anything that was touched on today. So thank you guys for all your time, and I'll just leave this poll live for a little bit, but you're good to go. Thanks.
Thanks. Take care.
Thanks, everyone.